right, this is your chapter 17, and this is, no, I think this is chapter 18. So this is your chapter 16 and 17. So this is the sources of business finance, short-term and long-term sources. Right, so this is your chapter 18, sources of business finance. It basically refers to different ways money can be raised by a business. Business needs finance to start the business and also for day-to-day running of the business. Most appropriate sources of finance depends on what the money is needed for. Is it long-term, short-term? How much is required? How long it's needed for? How expensive the source is. Long-term finance is used for startup capital, long life assets like buildings and machineries, and for expansion. Whereas short-term is used to manage poor cash flow, bridge gaps when large customers delay their payments, extra cash for sudden rush or orders. Short-term sources are overdraft and trade credit, so memorize these two. Overdrafting is an agreement with the bank to withdraw funds from your account that exceed the available cash balance. So you can draw more money than you have in your account. Good thing is it's flexible. A business can use overdraft only when it needs. Interest is only paid when you use this facility. Disadvantage is expensive due to high variable interest. The bank can withdraw the overdraft facility at any time. Trade credit, buy now, pay later. Advantages is it helps improve cash flow as business has the opportunity to make revenue from selling its product before it makes the payment. Disadvantage, it's difficult for new startup to organize. Businesses can gain a bad reputation if it does not make payment on time. Then you have long-term sources, which basically I think you have 4 of them: personal savings, venture capital, share capital, retained profit, crowdfunding, and loans. So there are 6 of them. Personal savings advantages does not need to be repaid. Entrepreneur keeps full control over the business. Disadvantage, amount available may be limited. If the business fails, the amount invested may be lost. Venture capital is like Dragon's Den. It can relate to either share or loan capital used by high risk new businesses. Investors might ask for high return or share in the business. Advantages, access to large sums of funds which may not be available elsewhere. Potential access to expert advice. However, possible loss of ownership and control over the business, and loans may need repaying at higher rates of interest. Share capital, money raised by issuing shares. Limited firms and PLCs can use this method. Advantage, no interest or repayments need to be made. Large sum of money could be raised, however, easy to lose control as the number of shareholders increase dividend repayments. Loans, money borrowed for a set period of time with repayment schedule. Advantages, financial planning is easier as repayments are made in regular installments. No control is lost over the business. Disadvantage, repayments include interest, security need to be given. So retained profit is profit kept by the business for reinvestment. Advantages, no interest or repayments because it's the business's own money. Does not dilute the ownership of the business. However, amount available may be low, not enough. Retaining profits may anger shareholders who might receive less dividends. Last is crowdfunding, raise money from wide range of investors. Good thing is it acts as a way to measure the popularity of the idea. Low cost investment, however, investors often need an incentive to invest, such as share in the business, or it could be difficult to gain the required amount. So that was your long-term finance.